So that the various risks that you see in the bond investments can be characterized into two divisions. So what we have is the risk that is arising from the interest rate. So those risks are called as interest rate risk, and any other thing which from where the risk is arising, that is called as the other risk. So what we say is, for a bond investment, interest rate risk is the most important risk that you face. So you have to think about that interest rate risk and see that how you can immunize your bond portfolio or can manage this interest rate risk. Okay, so under interest rate risk, what we see is, okay, there are various type of risk under the interest rate risk. One of the risk that you have is yield curve risk. So that means due to the change in the shape of the yield curve, you have certain risk. Then there is a call risk. What is call risk? So there are certain bonds which we saw that there are callable bonds. Okay, so if you are invested in a callable bond, the bond can be called by the issuer anytime. Okay, so such type of risk is called as call risk. When the issuer call back the bond, what you get is, you get a huge amount of dollar, okay, which you will have to invest at a lower rate, because we saw that investors will call the bond only when the interest rate have decreased. When the interest rate have decreased, it makes sense for the issuer to call back the bond. So when your issuer is calling back the bond, you have to invest this proceed at a very low interest rate. Okay, then related to the interest rate risk is prepayment risk. So here we are not saying it's a, I will say that call is a special type of prepayment, but in this prepayment what happens is, the issuer has the option to increase the prepayment. Okay, so a issuer may start paying principal more. Okay, so that is a prepayment risk. So call risk is like when the entire bond is called, whereas prepayment is when the issuer pays principal more than that was expected. So that is the prepayment risk. Okay, then you have reinvestment risk. So reinvestment risk is not only concerned with reinvestment when you are getting extra principal, but also you have to suffer from the investment of the coupons that you are getting. So the coupons also will have to be invested at a lower rate. So reinvestment risk, what happens is, whatever the coupon that you are getting, if the interest rate has decreased in the market, you would have to invest that coupon at a lower rate. Okay, as a result, what happens is, because of this coupon investment at a lower rate, the overall yield decreases. There is a concept of IRR. IRR says that the cash flow would be invested at the IRR rate. Okay, so in the bond investment you have a similar concept which is called as YTM, yield to maturity. Yield to maturity and IRR is one and the same concept. Okay, so what happens is, when the cash flow in the form of coupon comes, okay, you have thought that you will be investing that at YTM rate, but in reality you would not be able to invest at a YTM rate. You will have to invest at a lower rate. So what will happen is, you will not be able to realize this YTM. So as a result, what happens is, there is a risk. You thought that you will get 10% return, but because of the investment of the coupon at a lower rate, the return that you are getting is lower. Okay, so that is your reinvestment risk. Reinvestment risk, it is not only for dividend or coupon, it is for coupon plus principal both.